Hi, this is Zach Meir from Zach's Traders Cafe with a look at the major markets on Tuesday the 3rd of May. Starting off with the FTSE 100 and looking a little bit on the weak side here. RSI below neutral 50 at 48.76 and overall possible bullet bearish rising wedge formation. Fader at the 10-day moving average 63.29. But actually no support has actually been broken, so here we've got the 200-day moving average and the 50-day moving average towards the 61.80 area, which is also the floor of this possible wedge formation. The first thing to do really here is actually be buying towards the 6200 zone with an end-of-day close stop loss back below the 50-day average at 61.80. If you're cautious on the index and are looking for a momentum trade, that would be an end-of-day close back above the 10-day moving average at 63.29. It would be clear that then it could be up to 6500, which is the January resistance line projection. On to the DAX, and here slightly more positive in terms of the progress that we've seen here. Got this rising trend channel from the beginning of February, bounced off the 20-day moving average at 10,049 for last week. Support also towards the top of this gap to the upside and the 50-day moving average at 98.71. So that looks like a decent configuration, as does this uptrend line in the RSI window from as long ago as early February. And there's been a bounce towards the neutral 50 level. So basically, while there's no breakback below the 20-day moving average at 10,049, we're still looking for a 10,500 plus target. Any dips below that are currently regarded as a buying opportunity. Moving along to the US markets, and for the Dow, triple-digit rise to start the week, came off a hammer candle on Friday, so not too surprising that we saw that. Support here towards the 17,700 zone, and at least while there's no end-of-day close back below that, you're looking for 18,500, the top of this January trend channel. And this market's proved time and time again that going against the post-January uptrend or breakout recovery is a mistake. Onto the S&P, and looking robust here as well in terms of the breakback above the 20-day moving average. That's the grey line at 2076. At least while we're above that, we're looking for a return back towards the 2100 area, and also as high as the late January resistance line projection at 2200. That's set on the basis of this rebound for the RSI off the neutral 50 level to leave it at 55. If you're cautious on the bull argument, you wait for an end-of-day close back above the 10-day moving average at 2088, which isn't too much to wait on at this stage. The interesting market, I suppose, at the moment, as far as the indices have been concerned, is the Nasdaq, which has been hurt, obviously, by the fall in Apple. It's fallen 8 days in a row. Island top there, further gaps to the downside through the 200-day moving average. So still very much on the back foot here, especially while there's no end-of-day close back above the 200-day moving average at 44.21. While we're below that on an end-of-day close basis, looking back down towards that late or rather early March support below 42.50 over the course of May. So not a pretty picture still at the Nasdaq. Onto the currencies, and sterling looks rampant. Obviously, we've got the general dollar weakness over the last week or so. Rising trend channel here from January, heading towards $1.50. Initial target, the 200-day moving average at 148.67. And stop loss on the buy argument, and end of day close back below the 10-day average at $1.45.19. Obviously, this market also helped by the apparent walkover of the Remain camp as far as the EU referendum is concerned. On to the euro, and here it looks as though the lack of firepower as far as the ECB is concerned is starting to show, as is, of course, the dollar weakness I've just mentioned. Interesting scenario here that we've got after hitting the previous target, which was $1.15, which was basically a line of resistance like that. That was the previous call. Could be an upgrade here in quite a significant way up to $1.22, which would be the top of a rising September price channel. And that target valid while there's no end-of-day close back below the 10-day moving average at $1.13. 54. So quite a decent risk reward there. And even after recent gains, the RSI not quite overbought at 69 out of 100. The dollar yen has continued to melt down towards the 105 level. That was the area that we expected initially when we had the breakdown at the beginning of April. Obviously, there was that retracement and bull trap through the 50-day moving average, but we're back on course for the bears here. 104 to 104.50, the target here, and any strength back towards 107, 108 currently regarded as a buying opportunity. Interesting, though, that there is some bullish divergence in the RSI windows. Perhaps there is some intervention or some sense of people looking to bargain hunt this cross. As far as gold is concerned, to finish off, we hit the big $1,300 level to start the week initially. Slight pullback since then, but that's only to be expected. Former resistance here was around the 1270 zone, and so that could come in as new support on a sort of a more negative scenario. But basically, it would appear that while we're above that 1284 January resistance, there's plenty of upside here, perhaps as much as this line of resistance from February up to $1,350 over the next 2 to 4 weeks. That's it from me. More updates at the same time tomorrow.